traders think that adding or learning about more concepts is going to make them perform better. It's going to make them more accurate. Now, this couldn't be further from the truth. Social media also plays a huge role in this, because around you on YouTube, you see videos everywhere talking about this new best concept, this new best strategy. So what ends up happening, you start adding these concepts, you start adding more rules, thinking that that's going to make your results better. And at the end of the day, you know a lot about all these different concepts, but your results are still the same. They haven't improved. And the reason is quite simple, because those new concepts, those new trading strategies, they don't add a net positive to what you already know. It's what I like to call an empty confluence. Now, exactly what that is using the chart, I'm going to explain that to you in a bit. Once you understand these empty confluences, then in this video, you are going to be learning a lot, because that's going to allow you to understand which concepts do actually work for you and which do provide the results that you want to, which allow you to have a better technical analysis and a more accurate technical analysis. On top of that, it's also going to increase your edge. So your psychology is going to improve as well because of understanding empty confluences. And before we dive into how you can see for yourself which concepts do actually work and how you can increase your accuracy, we first need to understand why this actually matters. There's two reasons as to why this matters. Again, when we're talking about an empty confluence, we're talking about a confluence that doesn't have any net positive to your trading plan. So for example, if I look at the clock on my phone, then I determine it's 1 p.m. at this moment in time. Then I also look at my computer right here and I also determine it's 1 p.m. Then I also go outside to measure the sun right there to see and estimate what time it might be. Now, all these things lead to the same outcome because they all determine it's 1 p.m. Now, me looking at the sun, I'm going to put in a lot of effort to determine that it is 1 p.m. A lot of these concepts are overlapping. So they tell you the same information, you're just putting in the extra work. So that's why it's an empty confluence. So 2 clocks is not going to tell you the time any more accurate, right? That's the point I'm trying to make. So what is important to understand is when you start looking at all these different concepts that basically tell you the exact same thing, what are you doing? Have you ever driven in a car or tried to focus on anything? But for example, I think driving a car is a very good example. And you can't really find the destination. You, for example, took a wrong turn. And all of a sudden you start to realize that music, the radio is actually quite loud. Can Katy Perry please shut up for a moment so I can focus on where I'm trying to go? Or for example, you're trying to focus on anything else and there's someone just ranting in your ear about something. Can you please just hold it for a moment so I can focus on the task that is at hand? That's the exact same thing in trading. When you have all these different concepts on your chart, and you have indicators and you have all these different lines that you're trying to focus on, where some people's charts are going to end up looking like this. Completely full. This is the equivalent of you driving and trying to focus on something, trying to find your destination, and the radio is just ranting and screaming in your ear when you're trying to focus. Because what are you trying to focus on? Again, I need you to understand then a little bit what a retail edge is actually about. From a retail perspective, and specifically, I'm mentioning a retail perspective. So not institutional, not algorithmic, etc. For the majority of retail traders, psychology is going to play a huge role in your trading. Think about it. When you have a perfect edge, so a perfect statistical edge, and if it's coded, then again, we're talking about something different. But if you're executing that edge yourself, then psychology plays a role in executing that edge, right? Because if I give you the exact edge that I have, your execution of that edge is still going to be different because of your psychology, the difference in psychology, because of the difference in experience, etc., etc. So a large part of the edge actually comes down to you. That's important to understand. So you could have the perfect edge, but if your psychology always keeps you from profitably executing that edge, then you'll never be profitable. So if you have a very, very, very weak psychology, then your edge can never be translated over to the live market, right? Because sooner or later, you'll start overtrading. Again, I think you get the point. But let's say you have an extremely strong psychology, and you have somewhat of a decent risk management, then you can be profitable. So someone with a great edge, who has a weak psychology, can't be profitable, but someone with great psychology, but sort of a weak edge, is not really there, but great risk management can be profitable. And my question is, what is important? Psychology, the edge? Well, in my opinion, both are important. So yes, of course, you can't blame psychology if you don't have any proven edge or anything just yet. But you do need psychology to profitably execute that edge as well. From a retail perspective, if we know we need psychology to profitably execute an edge in somewhat of live conditions, then what is important to understand that you don't get distracted by the chart. So the more things you have on the chart right here that all tell you the same thing, the more brain points, as I like to call it, so the allocation of a part of your brain, what goes to technicals and goes to psychology, goes to the technicals. So imagine your brain is stuffed with the technical side, and you need to take into account whatever the oscillator and the VWAP and the Fibonacci is doing at that moment in time. And that takes up so much brain points, so much brain capacity, that you don't have any capacity left to actually focus on that psychology part. So it's a fine balance between the two. And that's why I like to call it, some traders actually get distracted by the chart. It's the same when you're trying to focus on what matters at that moment in time. For example, keeping your psychology in check. And all of a sudden, these technicals are screaming in your ear, all different information, etc., etc. On top of that, I believe that a retail edge oftentimes also comes down to psychology. Again, if you think about it, right? If it came down to the technicals, why wouldn't everyone learn just the same technicals and just be profitable? Because a large part is also on a retail basis. Again, a retail edge comes from experience a lot. So the subjective part. On top of that, also your psychology. Think about when you are executing a live market. And again, when you're trading prop firms, most of the time you're trading in a demo market. So this doesn't really apply. But think about how many people actually on the opposite side of your trade start overtrading, start revenge trading, start taking trades outside of the trading plan because they can't keep their psychology in check. So for a large part, I believe that's where a retail trader's edge is as well. Given, of course, that you have somewhat of a statistical edge, which again, we're going to dive into. So from a technical perspective, how can you actually make your trading plan better, make it more accurate without adding those empty confluences? Well, the point is that we need to find independent confluences. An independent confluence is, again, the polar opposite of what an empty confluence is. An empty confluence is another confluence, another concept that basically tells you the same thing that was already told by your previous concept. An independent concept is something that tells you something completely new. That's important to understand because the distinction between the two is oftentimes quite difficult to understand because two things might look completely different. For example, an order flow footprint chart might look completely different compared to fair value gaps. But the overall outcome of how you're going to take a trade, etc., might not change. That is important to understand. So the question to realize if it's an independent or an empty confluence, you want to ask yourself when analyzing your own trading plan is the following. Can you remove a confluence and the decision making would be the exact same? If the decision making, so the outcome, the trade ID that you're eventually going to take is the exact same, it's an empty confluence and it doesn't actually add a net positive to your trading plan. If it's not the case, then it might be an independent confluence. I'm going to give you a few examples of concepts that I've used in the past that I quickly came to the realization these are empty confluences that you also might be using. Now, I would highly advise be objective, look at your own data because for you it might be different again. But keep an open mind. So again, I can already see some people that might defend their favorite concept like, no, Arjo, you're wrong. It's not because of that. And they're going to leave a comment, etc., etc. Keep an open mind. Again, not just because someone told you to use a concept, keep an open mind as to why you're using the concept and if it actually adds a net positive to your trading plan. Try not to get defensive just simply because you like the concept. That's my point. There's 3 concepts. Now there's a lot more, but I just want to pick out these 3 concepts that don't add a net value, don't add a net positive to my trading plan. Those are equal highs and equal lows, SMT and IFVG, inverse fair value gaps. And I want to show you why these don't add a net value to my trading plan. Again, for you, this might be different. Most of the time, why people use equal highs and equal lows is, for example, right here, we have equal highs that we could potentially look to target in the future. Then again, you could also look at these equal lows. There's a lot of examples of this. You could also actually make the same argument for London highs, London lows, these session highs and session lows, New York highs, New York lows, Asia lows, Asian highs. These are all empty confluences in my opinion and for my trading plan. And the reason why that is because most people tend to use them. Okay, we have equal highs right there, for example. So that means we can potentially eventually look to target that liquidity to continue higher. It's the same thought process with these session highs and session lows. For example, this might be a London low, again, or it might be New York low, just an example, right? Because it's a London low and because it might be a session low, we can eventually look to target that, the same that we can potentially look to target in the future, those equal highs. Now, if we are already targeting, and think about this, right? If we are already targeting those highs, so I already have a clear bias right there to continue higher. Does it matter that there's equal highs at that moment in time? Arguably, no. Why not? Because if the price action right here already tells me that we are going to continue higher towards these highs, does it matter? Is there net value or net positive that those are equal highs or not? So oftentimes what you'll also see is that equal highs and equal lows will be left alone for a very long period of time until what happens? Until the price action turns around and the bias tells you that we are going to target those lows. So what is more important right there at that moment in time? The bias, so just price action right here, is already going to tell you that. So if we're going to target those equal lows right there, I can already see that by having those bearish fair value gaps right there. Then you could make the argument, yes, Arjo, but if we have a bearish bias right there and there's now equal lows, then it's an extra confluence. So that makes the bias even stronger. Now, unless you have specific data supporting that idea, for me, that's not true. Again, for you, that might be different because you might have different data, but for my data, I didn't see that. I didn't come to that conclusion. Those equal highs, equal lows, those session highs, session lows, they were an empty confluence. Because if it was happening, if we were targeting those highs right there, I would already see it happening. And whether that's an Asia high or London high or an equal high, that didn't matter. The same way that a lot of people use, for example, an Asia low right there that we can potentially sweep to then continue higher to target London or Asia highs, whatever the story might be. When you see that we have this Asia low that we might sweep, what is that inherently? That's a swing low. And if we sweep that swing low, I can already see that we might want to continue higher to target these higher highs right there. So inherently, what does it matter that it's an Asia low? It doesn't add anything. It's just a fancy word that doesn't tell you anything extra. It's like me making a lot of arguments and me just making the same argument over and over and over. It's like you're basically saying the same thing. You're not adding anything extra to the argument. That's important to understand because that's something we're going to dive into a little bit later as well. Now, the next concept, which is a controversial one, Twitter might come to attack me. But again, I need you to understand most of these concepts, they got introduced to you. So the reason why I know about equal highs, equal lows is because someone introduced me to them. And then I just thought, without critically thinking, I just thought, okay, well, let me just add it to my trading plan. That's usually how it goes. Someone tells you, hey, this works for me. You should also add it. You add it without thinking if it actually gives you extra value to your trading plan. So for example, one of those examples is SMT. And I'm convinced there's many traders out there that don't need SMT, but you just were told that you should be using it, or someone on Twitter who seems profitable, who seems to be doing better than you are, tells you should be using SMT, so you decided to use it. So SMT is often the difference between highs and lows between correlated assets. And I've also used it for a very long time. And I start looking at my data, it doesn't actually add any net value. So for example, right here, if I look at ES, you'll see ES made these higher highs. Now on NASDAQ, we see right here that those same highs were not higher highs, but lower lows. So this high did not stick out above that previous high right there, where on ES, it didn't. Now, according to SMT, what that means right there is there's a, somewhat of a glitch in the algorithm. Don't get me started on that. So NASDAQ right here is the weaker one to potentially continue lower right there. That's the one you want to short because it did not have the manipulation above that high. Now then some people make the argument, no, you actually want to short the one that did manipulate right there above the high to then continue lower. So then in this case, you would look to short, for example, NASDAQ, because this did not make that higher high like ES did. And that works the same, for example, between a Euro US dollar or a GU, etc., between two correlated instruments. Now, what is important to understand is that this comes down to a lot of foundational work. So what I do in my trading plan, and if you, learn, for example, from the MMT, you'll learn about this, is that if you're looking to buy, you always want to buy the strongest instruments. Why? Because if you're looking to buy and you're always buying the strongest instrument, then it has more potential to move higher even more. So the trade just has less resistance. It's more likely to work out. It's super basic probabilities. The same way, if you're looking to short, so you're looking to sell something, you want to short the weakest instrument because that has more potential to move lower. So when I do my analysis right here, and before I look to even enter, what do? I look at, okay, NASDAQ right here has been weaker than ES. Why? The fair value gaps towards the downside are larger. If we, for example, look at the lows right there, we are way beyond these lows compared to, for example, an ES, which is still struggling with that low. So a NASDAQ at this moment in time might be a lot weaker. And if I understand that, then I might say to myself, okay, if I'm going to look at shorts, I'm going to look at NASDAQ. So if I look at shorts on the weakest instrument right here, SMT is guaranteed to already happen, but I've already picked the right instrument. It's the same way, for example, why in MMT we were interested in buys on an EU right here to continue higher and not, for example, a GU. Because a GU, you'll see, this didn't even create a bullish fair value gap, but an EU right there created, many bullish fair value gaps at that moment in time. So an EU inherently was stronger right there. So of course, will you see SMT between an EU and a GU? Yes, but inherently, it doesn't add a net value. There's no net positive because I've already determined that through picking the weak or strong instrument. And again, for you, that might be different, right? For you, that might not be the same. And if that's not the case for you, then it might be an independent confluence. But for me right here, you'll notice that was an empty confluence because it already told me what I already knew, if that makes sense. Now, then my favorite next example, inversion value gap. I can ramble on about this topic for the next 2 hours, but again, I'll save you some time and a headache probably. One of the first things that I mentioned regarding fair value gaps and these things on social media was that if you use fair value gaps, you don't need a market structure shift. And everyone ran with it, right? The reason why I mentioned that a market structure shift already happens if you have, for example, a bearish fair value gap. So oftentimes that market structure shift is also an empty confluence. You don't need to pay attention to it. Now, you could, of course, make the argument that a market structure shift already happens, so you don't need to pay attention to the fair value gap. And I can see that. It's a very fair argument. And then it depends a little bit on what you want to use. But then you still need to realize that there's always empty confluences. So the same way in, for example, an inverse fair value gap, which I think if you understand and use fair value gaps, then inverse fair value gaps are the most useless concept that is out there that has ever been marketed, in my opinion. And I'll explain to you why. But of course, if you use inverse fair value gaps, then it might be the opposite, where inverse fair value gaps might make the fair value gap irrelevant. And if that's the case, if you use inverse fair value gaps and you see, hey, I'm also using fair value gaps, but they don't add a net positive, perfectly fine, right? I'm not here to argue which concept you should be using. I'm here to open your mind to see how many empty confluences you have in your trading plan. And also, when you start improving your trading plan in the future, see, is this actually worth adding? Because I also look at certain concepts, for example, where I think, okay, a footprint chart, could I add that to my trading? Does that make my trading better? I looked at it, I studied it, it didn't add anything to my trading plan, not something that I didn't know already. That is the whole point. So what an inverse fair value gap actually is. So for me, this is one of the concepts that is arguably the most dangerous. And especially if you already trade the way I trade, for example, with fair value gaps focused on order flow, then this concept will completely ruin your accuracy and will not add any value. And the reason why that is because if we overtake this bearish fair value gap right there. There's a lot of concepts that go into it, token rejection, etc. But if we just keep it simple, if you just follow along with the most recent fair value gaps at all times right here, then at this moment in time, what we could potentially continue higher from is this bullish fair value gap right there. So now you'll see I have an extra large area that doesn't inherently give me extra value to know what is about to happen. I can see that we overtook this bearish fair value gap, yes, but this bullish fair value gap already told me that. And the bullish fair value gap is what we now are potentially trading back into to then continue higher. So this fair value gap is completely irrelevant. And that is, again, if you, for example, are familiar with the MMT, following the most recent order flow lags, inverse fair value gaps are just not useful. They are a completely empty confluence. For example, this right here, this would also be an inverse fair value gap. And you could drag it out all the way to the right there, would act as support and resistance. Here we bounce off it perfectly, right? But if you just follow along with the most recent fair value gap, we see we have this bullish fair value gap, potentially what we could continue higher from. Here we have a swing low. That's what we reach right there to then continue higher and we sweep it. Here we have a bullish fair value gap that actually fills. Here we now have, and we don't drag it all the way towards the right there. No, this one just fills. Now we have a bearish fair value gap that we can continue lower from. And when you're using those most recent objective PDWs, that's where your accuracy increases a lot. And you'll notice the inverse fair value gaps, when you trade like this, they don't add any net value. But that's the last example I wanted to give you, but there's many more of these examples out there. There's many fancy or seemingly very fancy things, very fancy new concepts that are just basically the same old thing that you already knew based on previous concepts. So before we dive into how to then create your accuracy and how to improve your edge using this, I need you to understand a lot of this comes from very foundational work. So not necessarily very fancy things. For example, I start off with my analysis picking the weak and strong instruments. So strong instrument for if I want to buy, the weak instrument for if I want to short it. And that already tells me what the SMT is likely going to do. The buyers right here, they already tell me if we're going to target the Asia highs or the session highs or the equal highs. Those recent fair value gaps, they already tell me what an inverse fair value gap is doing. And like I mentioned, there's many more of these examples where these fancy new things are just basically telling you the exact same thing. So again, imagine if I have just a very basic clock that doesn't seem that fancy. It just tells me the time, perfect. And then I buy this super digital, high dynamic, beautiful, with a lot of features clock. And it tells me the exact same time. Like, well, it's pretty useless, a waste of my money, waste of my time. And that's important. And when you start to strip down, so you start to remove these empty confluences, then we can move on to the next chapter, how to increase your accuracy, how to get a better edge. Then what is important, when you remove those empty confluences and you only have independent confluences, you can really isolate as to why something works and why something doesn't work. So you can really accurately gather data. So less things on your chart with more independent arguments, so that only accurately tell you one singular thing, that actually increases the accuracy and you know what you should be paying attention to right now. On top of that, those independent arguments, they exactly create arguments. So what I mean by that is that, for example, if you have a lot of these different things that essentially tell you the exact same thing, it's almost like a coping mechanism. You know what I mean? Where it's like they tell you the exact same thing because it's basically a same concept, but a little bit different. And the concepts might tell you twice that it's bullish. But because it's the same concept, it's the exact same, like asking the same person the same question. So when you're talking to yourself, of course, then if you have an argument, you're going to agree with yourself oftentimes. Whereas if I now have an argument with an opposing person, they might disagree with my argument. So oftentimes it's better for feedback to have an opposing argument than to have the same argument. So that's why if you have the same concepts, they're going to create the same arguments. If you have opposing independent concepts, they're going to create opposing arguments. And then the argument to be bullish or bearish is going to be a lot stronger. If you see them in the chart, so for example, if you see a bearish fair value gap being created in the chart, that might be a bearish argument right there. So the market is suggesting that we might want to continue lower. The same way, if you do use inverse value gap, if we inverse that value gap, that might be an argument that we are bullish instead. So every concept is an argument in itself. It's something that the market is suggesting. So for me, the bearish argument doesn't follow through lower. Okay, now we have a bullish fair value gap. Now it might be suggesting right there that instead we are ready to continue higher. And if I do that for a lot of these time frames, eventually you're going to get to a certain conclusion. Either that conclusion is going to be, we have a lot of contradicting arguments. If you have a lot of contradicting arguments, the conclusion is just not clear. When the conclusion is not clear, there's no high probability trade ID. There's no high probability decision to be made. But if you have a lot of the same arguments, so all the bearish arguments, for example, are gone, you only are left with bullish arguments because of the concepts that you are using, those independent concepts, then you have a very conclusive decision that you can make. And that in turn, then increases your accuracy. So let me give you an example of that. So right here, for example, if we go over a couple of time frames right here, Nasdaq, I might argue that on the higher time frame, we do look quite bullish overall. So we might want to continue higher on the higher time frame. On the weekly, that's arguably similar, even though the recent weeks we have been moving lower. If we take a look at the daily right there, so that means that the monthly, the weekly, my arguments might be that we want to continue higher. If I look at the daily right here, well, I can see that we are, for example, running this swing low. It does not seem like we are respecting at this moment in time this bullish fair value gap. So the daily is actually contradicting based on the concepts, based on the arguments right there with the weekly and the monthly. If I look at the 4 hour, I could argue that this bearish fair value gap right there might be failing. We have a bullish fair value gap at this moment in time. So you could argue that this might be more bullish than the daily time frame again, even though we see that we have had bearish order flow right there to continue lower as well. Again, you'll notice right here, I have a lot of contradicting arguments. And when I have a lot of contradicting arguments right here, it's not ideal. So what you want to wait for is until the arguments start to align with the other arguments. So the monthly, the weekly were bullish, the daily was bearish, arguably, and the 4 hour, a little bit in between. If we now start to continue higher, start to create more bullish fair right there, we have more bullish arguments on the 4 hour and the daily as well, which align itself with the weekly and the monthly. That's when something becomes very high probability, because then eventually we will get to the conclusion, well, we could only really do one thing right here. For example, on the dollar, we see that we have this swing high right there. Now on the weekly, on the monthly, we're arguably sweeping that. We also have this bullish fair value gap. So this is a bearish argument. This is a bullish argument right there. On the weekly right here, nothing really as well. You could argue that we are actually running this low right there. Another bearish argument. If we go in the lower time frame, we also see right here that the monthly fair value gap is already getting disrespected. So we keep running these lows right there. We keep running these lows right there. So this bullish argument, the only bullish argument that we had on the monthly time frame, is arguably fading away. It's not relevant anymore at that moment in time. So we see that we create more bearish value gaps right here. We keep running lows. We keep running towards the next lows right there as well. I can only really find bearish arguments at this moment in time. And when that happens, that makes something high probability to then, for example, start looking at shorts until we can introduce another variable, another probability, another possibility of what might happen. Probabilities are just possibilities, right? The less possibilities there are of something happening, the higher probability a certain decision is. But the more different possibilities of what could potentially happen, the lower probability a certain decision is. For example, right here. Now we reach this swing low. Now there's a possibility that we might sweep this swing low to then continue higher. So if we don't sweep it and we confirm that we are running that low instead and we start to continue lower again towards these lows, then that means we are not sweeping. We can objectively see we are not sweeping that low anymore. So we take away the possibility of that happening, which means that the possibilities that we are left with then become a higher probability because we remove a certain possibility. To fully understand probabilities, I would advise anyone in their lifetime to play the game Guess Who. Because if you play the game Guess Who, then again, the person in front of you has a certain character. So out of the 50 characters, that person has chosen one character. That's that character. You need to guess that character. So who they have as their character. Now, the more questions you start to ask. So at the start, of course, there's many different possibilities. And because there's so many different possibilities, that makes one choice lower probability. But if you now start removing possibilities, so you start to ask, well, is your character wearing glasses? No. Okay, so let's say 10 fade away. Then from those 40, if you now choose, there's less possibilities. Now, of course, it's still not super high probability because there's 40 left, but it's higher probability than what it previously was. So that's the same exact thing in your trading. If we are not sweeping this low and the possibility is now gone, then we can assume that we are running this low. So then the possibility of reaching those next lows is a lot higher probability because there's less possibilities of what price might do next. And this all starts from first having independent concepts, independent confluences. Because if they're all overlapping, then you can't make an accurate argument because you're just basically saying the same thing in different words. This is advanced, I know, but if you want to master your technical analysis and you want to increase your edge, this is extremely important to understand. So I'd highly advise maybe watching it twice or moving on to this next video that will also help you to understand these scenarios. All right, perfect. Thank you.